Hi, this is Anthony Parent of IRS Medic, and thank you for joining me today. I have a fantastic guest that's actually solving a big problem of a few of our clients. Because here's the thing: if you are used to deal with the IRS and you're looking for tax savings, you know what I often tell people is that, well, if you have a lot of assets, you might be able to find a tax strategy. If you have a business, you might have a lot of you might find a strategy. If you don't have that, then look to real estate, and those are the ways you can find some real tax savings. And this is how my conversation actually came up, and why when Nancy reached out to me, I was more than happy to talk to her. And I'm very, very happy because she can help a lot of our clients, and maybe she can help you too. Because here's the problem for a lot of people: that if you're looking to get a savings on your tax and invest in real estate, well, how do you do it? Where do you start? Let's say that you have a full-time job, that's a high income job, high demanding job. You might not have all the time in the world to become a property manager and do all these things. So Nancy, you have some solutions out there for some investors, and we'll get to that. But I just want to talk a little bit about you and how you are an ex-attorney yourself.
I
Is that right?
am
You are? Oh my.
and a recovering attorney.
Oh, well, someday I hope to join you. Someday I hope to join you. So good for you. Awesome. So let me just share with people your bio that you have on your website here. I'll just get that up
Sure.
right now. And here it is. Why is this not doing it? Hang on one second. Small technical thing, and just change the layout. There we go. Good. See, I have it right. I'm doing pretty. So here's your website. You are the founder and chief executive officer of 23rd Street Investors.com. Now, I'm imagining 23rd Street is a fancy place, wherever it is, wherever you're located. Is that right?
Actually, 23rd Street is where my first multifamily investment was, in the Mission District of San Francisco.
All right.
Very first building I ever purchased.
Oh,
So thus the
wow.
name of the company.
Oh, right on. Okay, well, fantastic. So you've been doing this for a while. You retired as an attorney from 2013, and so now you're on to perhaps more fun and enjoyable things than the
Yes.
practice of law, helping people get really putting real estate investors and developers together. And really, what we're talking about today is we're going to be talking about something that's called a syndication, real estate
Correct.
syndication, and how that can help people get into real estate. Others that haven't been able to. So let's get into it. You've presented some slides today. So let's get those slides up right now. And here we go. So here's some slides that you presented for us today. So to explain to this how real life ideas for people to lower their taxes.
Well, obviously, we have to have a disclaimer.
There we
So
go.
I'm not
You're-
offering any investment advice, legal advice, or tax advice. This is just for educational purposes
There you
only.
go. Great. Right. We're attorneys here, so we want to make sure we're doing everything the right way. So let's start off with this. Okay. So, and let me just maybe lay out the problem that people have is that you want to get into an investment, but maybe you don't have enough money to buy a big thing. But maybe your portfolio isn't exactly doing well in the stock market, and you want to get into real estate, but you're not quite a big enough fish to do that. You don't want to sort of risk everything in one big thing that could consume all your time and put you in a worse situation. So with that, what's a syndication? Is that something that could help people?
Yeah, this is just an alternative way to invest. If you want to go to the next slide. Basically, a syndication is a partnership between the operators and the investors to pull resources into a single investment. And at 23rd Street Investors, our primary focus is multifamily investments, which
That's fantastic.
basically means apartment buildings.
Okay, fantastic. So this is what you do. You find an apartment building.
We find
Right.
an apartment building, and then we do our due diligence. And what that means is we walk the building, we look at all of the finances, we get our contractor out there to tell us if there's anything wrong with the building. We also look at what we're going to do to improve the building, and we get estimates for that. We look at the rent rolls, we look at the bank accounts. And then once we do that, if you want to go to the next slide, we underwrite the project, which means that we put all our numbers into our analyzer. And what we're hoping for, what our goal is to double our clients' money in 5 years through a combination of cash flow and back end profits. And so when we underwrite, we see if we can meet that objective or at least get close to that objective.
Well, that's pretty nice. Doubling their money, that's fantastic. And a lot of people having problems with their stock portfolios right now getting
Right.
that. And so then,
So after we do that and we know it's a go and we get the project under contract, then we present the deal to our investors. And they get to decide whether or not they want to go into it.
fantastic. Wow. So I mean, it sounds like you have a whole package ready and really a solid package that's supported by a ton of documentation about what really should happen.
Right.
Well,
And then once we get our investors in, we actually close on the property. We do our improvement plan, we run our business plan, and then we operate it for
all right.
usually about 5 years.
Okay. Is there a reason why just 5 years or?
Most people want their money back after 5 years.
Okay. All right.
And the other thing is if we're doing improvements in year 1, by year 5, you're starting to see some wear and tear. And instead of going in and making more improvements, we sort of leave that for the next buyer. And
Right
so we sell the
on.
property in 5 years and distribute the profits.
All right. Well, that sounds like a pretty good deal. Double your money in 5 years, and then you distribute to profits. Now, so the question is, so why? I mean, I have my reasons why investing in apartment buildings, but I'd love to hear yours. You seem to know a little bit more about it than I do.
Okay, well, we can go through that. First, the
Okay.
cash flow. A well-stabilized apartment building should be producing cash flow. And if we're doing a value add project, which means we're doing a lot of improvements and new management and stuff at the beginning, you might not see cash flow for about 18 months.
Okay.
And then after that, you should be seeing some cash flow.
All right. Okay.
High demand, people
Yeah.
need a place to live. Usually we're investing in the Southeast
Okay.
because you've got businesses moving in, you've got people moving to the area, you have rents going up. So those are the areas that we're looking at. And in those areas, there's just not enough housing for the
No.
demand.
Yeah. You're absolutely right. You're absolutely right on that. Yeah.
It's a hedge against inflation. There was an article in Forbes that said if you're worried about what inflation is going to do to your retirement dollars, you should think about some alternative investments like real estate, because as inflation goes up, rents go up. And so if you own an apartment building, your income goes up.
Well, and I think here too, you're also looking at shorter term deals that aren't going to lock somebody into a rate of return that's contingent. It's a good rate of return contingent on what the inflation rate is, but maybe not a good rate of return on overall. So that's nice. You're keeping them kind of short term, but long term enough for the tax benefits, but short term enough where you're not going to be boxing yourself into something that's not going to work out in the long run.
Well, and at the end of 5 years, you can always roll it into another similar type investment if you choose to do so.
Yeah, which is probably a really good idea. And I think here's what got my here's why I'm as a tax professional here's where I'm interested in the tax.
There are
benefits.
tax benefits, and I've got slides later on to talk about
Okay,
those.
great.
Appreciation. There are times when properties go down, like 2008. But the reality is they come back, and when they
Yep.
come back, they go up higher than they were before they went down.
Yeah,
So
absolutely.
overall, properties are going to appreciate. With apartment buildings, you have economies of scale. So you could own 100 houses, which are very difficult to manage, or you can own one building with 100 units. And so you just have the ability to scale. You can have an on-site manager. You can have an on-site maintenance person. So
Right,
it makes a lot of sense.
It makes, because if I would say this. Let's just even just use sort of round numbers. Let's say that if you are buying one apartment building, one apartment unit by yourself, and of 100 unit, well, you carry all that risk of making sure that one is rented out and you don't have a bad tenant. But let's say that you have a 100th interest in a 100 unit. You're taking advantage of the economy of scale of management, but now you're also sort of diversifying your portfolio and spreading your rental risk over a larger pool so that you won't be the one who is in a bad situation.
Correct.
So I really like that.
Leverage, we can buy a $4 million property with only $1 million of investor funds, and the rest is supplied by the bank. Can't really do that with stocks.
Yeah, they don't like that. They don't. Yeah.
And investment stability. I mean, it's a real asset.
It's an asset.
You can go, you can visit it. The chances of it going down to zero value are virtually zero.
There's a lot of things that have to happen first, right? So now let's move on to passive real estate investing.
So basically, in passive investing, the operators, the general partners like me, do all the work. We find the property, we go through the escrow, we hire the contractors, we hire the property manager, we, run it, collect the rents, all that stuff.
You really love this, don't you?
I do.
You really do. I could tell.
And as a passive investor, you review the documents when we put it together, and they're legal documents. You attend a webinar where we explain the project, we go over the numbers, and you get the opportunity to ask your questions. If you like the deal, you sign, you contribute your funds, and you become a limited partner. And then you just sit back and wait for the checks to come in.
Well, okay.
So this is what we mean by passive investor.
Truly passive. All right. That's not too bad. So now we're going to go into a few different ways to invest, some particular ways.
So individually, you've got a bank account, you got $100,000 sitting in it, you want to invest it, you can simply put it in your individual name.
All right.
You can invest with your spouse, which a lot of our investors do. A lot of people have a living trust, and so they invest in their living trust so that if something happens to them, their interest is held in their trust.
Nice.
A lot of people invest through an LLC, either individually they have an LLC, or, maybe they partner with friends or with family members and they form this entity. Then that entity can invest in a syndication.
Wonderful. All right.
And you can invest through your 401k and your IRA. And I know this has an interest for you.
Yes, it does. Because this is really, because when I was sort of putting this together, it seems like it's solving such a huge problem for so many people out there. And somebody in particular I know was just complaining to me in a car drive on Sunday. He was complaining to me. He's like, oh, my 401k, it's down to $140,000. And he goes, and it just lost $5,000. It started at 260. I know he's taken a little bit out of it, but this thing has been not doing well. And now here's the thing. He has invested in real estate. He bought one condo that didn't work out, and he lost a little bit on that. He did buy one in Florida, though. That did well. He did. Oh, boy, he got that right at the right time, fully furnished. And so that one did fantastic. So he's been asking me, it's like, well, I'm looking for a little, thing. And this is the thing with that $140,000 that he has to invest is, first of all, it's in a 401k, and we can talk about that, but he's really limited on what you can buy for $140,000. You're going to be stuck with something probably small, and it might not be in the best area. It might have a whole bunch of problems. It might not be really where you want to invest, but it's your only choice because you don't have the larger funds to get in a bigger project.
Right.
And you're solving that. Now his money can work a little bit harder and things open up to it.
Right. And our minimum investment in a lot of our deals is $50,000, anywhere from 50 to 100. So with 150,000 in your IRA, you could invest in 3 different deals. Now, the tricky part is if you want to do this, you can't just write a check out of your regular IRA or 401k. You have to set up what's called a self-directed IRA.
Okay.
Or a self-directed 401k. And that takes about 6 to 8 weeks to do.
Okay. All right. Good to know.
So if it's something you want to do, you don't want to wait until a deal is presented, because sometimes deals sell out within days.
So really the first step, if this is how you're going to do, just start on moving into self-directed IRA before you start looking at things, because things are going to go quickly. But then 6 to 8 weeks, now you can start looking and
Right.
really, okay, all right, all
And
right.
one of the things to keep in mind, if you haven't reached the age where you have to take mandatory distributions, this works really well. Once you reach that age, you need to look at whether or not investing will allow you to take out the money you're required to take out. Because
Okay.
again, your money's tied up for 5 years. The cash flow may not be enough to meet your minimum distribution requirements. So it's just something you have to be aware of if you're older.
Right. Well, and actually he is of retirement age. So that's something that he would not be able to invest basically that a full amount. He's got to reserve some back so that he could
He,
pay those withdrawals, made those forced. Okay.
yeah, he'd have
That's
to
great to
look
know.
at that.
Okay, great to know. All right. Well, thank you for that. I can't wait to show him this part of the presentation. I'm excited for him. Now we're going to be talking about some things here. Tax benefits. Oh boy, we love this. We love this. So
Well,
here we go.
the best part about real estate is that you get to depreciate the assets.
Yeah.
And with residential real estate, usually the life of the building is 27 and a half years. You can't depreciate the land. So normally you take about 75% of the purchase price and you attribute that to the building, and you can write that off at 3.636% a year. And the depreciation offsets the profits. So, you have $100 of income, you have, $50 of expenses, your profits are 50, your depreciation offsets that 50, so you're only taxed on what's left. With most of our investments, the depreciation writes off every bit of the income.
So
So
you're
there's
you have income, but you don't have taxes because you're appreciating.
correct.
Yeah, and that's incredible. Now, I would say, and I don't know if this is something that's in the next slide. There, yes, you
There it
read my
is.
mind.
Yeah,
You
so,
read my mind.
3% a year doesn't sound very good, but
Yeah,
there's a thing
yeah.
called cost segregation. So what we do is we divide the property into components, and there are companies that specialize in this. They go out to the property, they look at everything, and they take the appliances and the HVAC and the plumbing and the roof and all the equipment, and they put it into categories that have different useful lives, anywhere from 5 or 7 or 15 years. And so what you get to do is you get to depreciate those items over a much shorter useful life. And so you're front ending the depreciation, which is what allows us to, you know, write off all the profit on a project.
Wow. Yeah, that's just amazing. And you're also, when you said 5 years, that you're usually holding for 5 years, I was like, okay, that makes a lot of sense from a cost segregation perspective. Because you're really, because in that first 5 years is when you get the bulk of the tax benefits. I had
Correct.
Dawn Poland on my show yesterday, who is cost segregation specialist, and we went right through it to show it's like really that first 5 years, it's just incredible. What you can get for tax savings with investing in real estate and cost segregation, and it's really the way I was thinking of it was. There's very few ways that we're all dealing with this income tax that wants to destroy our wealth. Its entire motive is to destroy our wealth, and this is one way where your wealth isn't destroyed. It isn't. You're actually able to invest without getting hammered again and again and again. So just one, I love this. I love this. I do love this. Wonderful. And then,
There's
of
bonus
course,
depreciation. So
yeah.
this is a special rule where you can accelerate depreciation. So cost segregation already accelerates it, but bonus depreciation allows you to write off 100% of assets in year one if they have a useful life of 20 years or less. So we just saw that with cost segregation, the useful lives of the components are 5 or 7 or 15 years. So all of that can be written off in year one. And if you don't need all of it in year one, you
Yeah.
carry it over.
Right.
So,
Right.
it
So,
works out pretty well.
yeah, and the point being is that your passive income is basically coming in tax free. That's really the
Correct.
point, and it doesn't need to be in a 401k for that to happen. That's then just to be
Well,
clarified. It does
401k, you really don't get tax
right,
benefit.
and you don't really get it right, but you don't. And so that's I just want to make that clear to people. I'm not talking about this as an investment account. I'm just saying if you just wrote the check from your bank account. If you just wrote a check from your bank account, you really could get, an incredible return on your investment tax free. And
Yeah, and just going back one
oh yeah,
second,
go ahead. You bet.
the 100% accelerated depreciation ended last year. And so now in 2023, it's only 80%. And it's for buildings that are put in service, in 2023. And then it phases out 20% a year.
And now this
1031 exchange.
this
So
is
I've got clients that have investors that have properties, talking like a lawyer with clients. But I have investors who have been managing their own properties. They're older, they're tired, their kids don't want any part of it. And so they're trying to figure out a way to get out without paying a huge tax. So in some of our deals, not all of them, but in some of our deals, we can accommodate a 1031 exchange, which is where you sell your property that would have a large taxable gain and you exchange it into an interest in one of our apartment buildings. Now you defer the recognition of that gain until the building is ultimately sold or you die. And as I said, we only do this for 5 years, but if you come in with a 1031 exchange, then in 5 years, you can exchange your interest out for another property. So it'll just keep going until you die.
And so you're deferring, and then this is, also it's a terrible day, of course, the day we pass. But there's a little upside for your heirs, and that capital gain that you would have to pay if you sold, now transfers to them with a stepped up basis, meaning that what they now have, the value of the property and what they can depreciate is the fair market value of the property on the date of death. And there's nothing to stop them from cost segregating and even getting the same benefit and continuing down the road.
And if they're like most kids that don't want anything to do with real estate after they've watched their parents, you die on day one, they can sell on day two and pay no taxes.
Pay no taxes. So this is an incredible strategy that you put together here. I love how you put all the components together. You created a whole system. You really created a beautiful system here that I think takes advantages of the benefits of owning real estate, the tax advantages, the various benefits, and the market advantages. And then you've made it into a package for the regular, normal, everyday investor. They don't need to go in with a big deal. They can start with a couple. They can start with a small one. They can start as low as $50,000. See how that goes. This is a short-term thing, and I'm really impressed by how you have everything really figured out here.
Yeah, and real estate investing is risky, just like anything.
Sure. Yep.
So, you wouldn't want to invest, your last $50,000 or your child's educational fund. You want to have excess money. Like I tell my investors, if you can't afford to lose it, you shouldn't invest it.
Right, and I think there's just so many people could start off with the $50,000 without putting themselves in an uncomfortable position where,
right.
There's a lot of anxiety when everything you have is on the stake. But hey, this is such a great way to diversify and really take advantage of things, Nancy. I'm really impressed by how you did. I'm very happy you're no longer an attorney.
Me too.
So we have your website up here, 23rdstreetinvestors.com. If people want to reach you, how would they do that? What's the best way to reach you?
You can email me, Nancy at 23rdstreetinvestors.com. And you can go to the website. I've got some educational materials. I've got a passive income guide. You can sign up for our investor club. What you do is you join the club and then you have a conversation with me. We talk about what your goals are, make sure that you're not using your last $50,000.
Yeah.
We look at how quickly you want to invest, all those kind of things. And you can ask questions and then you become part of the club. And as we get investments, you get an email that lets you know about it. You can jump in if you want.
Oh my God, this is great. Well, I think I have at least one not client for you. What do we call investor? I have one investor for you, and I'm really excited that we bumped into each other. Congratulations on all this. Anything else you want to add before we conclude?
No, I think that's about it. If you're hesitant because you are reading in the papers about, investing in real estate is risky right now. Man, I wish I had invested more in 2008. Now's the time to invest.
That's when the
great
bargains were. Yeah,
deals.
right. Yeah, absolutely. All right. Well, thank you so much for joining us today and sharing this, Nancy. Looking
Thank
forward
you.
to sending some investors your way. Really
It was
appreciate it.
fun. Thanks,
Thanks a lot.
Anthony.